You want to know the truth about this business of trading? It's simple, but it isn't easy. That's the part most people never truly accept. The market will present you with endless opportunities every week if you go searching for them. But how many of those setups align with a clear, consistent edge? How many actually match your belief in probability and discipline? That's where the real work lies. Trading isn't about taking every move the market offers. It's about waiting for the moments when the probabilities are stacked in your favor, when your mental state allows you to act without hesitation, fear, or hope. Have you noticed how uncomfortable it feels to do nothing when the market is moving? That's where psychological discipline is tested. That's where most traders lose themselves. I spent years learning that the hardest part of trading isn't analysis. It's managing yourself. I made money, lost it, made it again, and lost it once more. That cycle repeated until I realized the only trades worth taking are those that align with my edge, where the potential for reward is greater than the emotional risk I must accept. Do you see the difference between acting from emotional need and acting from genuine alignment with your plan? Most don't. They trade to feel involved, to prove something, to avoid missing out. But the truly consistent trader knows that waiting is an action, that patience is a position. Often it's the most powerful one you can hold. You might ask, what makes a setup high probability? It's not about a magical formula or a hidden indicator. It's about alignment between your beliefs, your perception of the market, and what the market is actually showing you. Think of it like a poker player who knows his odds. You don't play every hand. You wait for the situations where the probabilities make sense. A high probability setup is your edge expressed through price, trend, and behavior. But tell me, when you look at the chart, are you seeing what's there or projecting what you hope will happen? That's the difference between trading in the moment and trading in illusion. The market constantly communicates. Every tick, every bar, every reaction reveals information about the collective psychology of participants. A market that refuses to drop on bad news is communicating strength. A market that rallies and holds on strong volume is telling you something important. Are you listening? Or are you arguing with the market, trying to impose your will upon it? That's the psychological test you face every day. When I talk about high probability setups, I'm talking about clarity. Moments when the market's behavior confirms your edge. A breakout after a long consolidation, for example, is not just a technical event. It's the emotional resolution of tension between buyers and sellers. Once that balance breaks, the probabilities shift. The market has coiled, and now it's ready to expand. Doesn't it make more sense to act when that energy is released rather than when it's still building? Yet many traders jump early, driven by anticipation rather than evidence. Then they wonder why the move fails. The high probability play is to wait for confirmation, to let the market prove itself. Proof costs money, yes, but hope costs more. Trends are another form of confirmation. They exist because the collective mindset has aligned in one direction. Fighting that alignment is fighting probability itself. If price is in an uptrend, making higher highs with strong participation, do you really need a prediction to know where the probabilities lie? Yet many try to call tops, motivated not by logic but by ego. The need to be right rather than to make money. Ask yourself when you study the chart, are you identifying where the large participants have placed their bets? Because that's what you're really seeing. The footprints of collective conviction. The crowd doesn't move the market, it reacts to it. The professionals act without hesitation because they've accepted the risk. They don't need certainty. They operate from probability. That's all a high probability setup is. A moment where your mindset and the market structure align. Of course, risk is always present. No trade is certain. Every position carries the potential for loss. That's why the consistent trader defines risk first, mentally and financially, before even thinking about reward. A high probability setup isn't defined by how good it looks, but by how well it fits your rules of risk and expectation. If the potential reward is 3 or 4 times your risk, and the structure supports it, that's alignment. But if you're risking $1 to make 50 cents, you're not trading probabilities. You're trading emotion. The mind is the greatest challenge in trading. It tempts you to act when you should wait, fills you with doubt when you should trust, and inflates your confidence when you should stay cautious. How often have you chased a move because you feared missing out, only to buy the top, or jumped in early, only to watch price drift the other way? That's your belief system at work, unexamined, emotional, reactive. True consistency begins when you stop needing to be right and start thinking in probabilities. The market reflects human emotion, fear and greed, oscillating endlessly. But beneath those emotions are patterns of behavior that repeat, because human psychology doesn't change. The same formations appear decade after decade because traders' minds don't evolve as fast as technology. Chart reading isn't mystical. It's a mirror of collective emotion. The real profits come not from catching every wiggle, but from understanding when the conditions for a big move are in place, and then letting the probabilities play out. You don't get rich by scalping noise. You build wealth by aligning with the flow of collective conviction and staying in until the market tells you otherwise. Consistency comes from belief, not in prediction, but in your edge. The temptation to take small profits will always be there, but cutting winners short destroys your edge. There are few truly high probability setups each year. Why sabotage them by exiting too soon? The consistent trader learns to distinguish between market noise and genuine opportunity. When you're in sync with your edge, you let it work. Manage risk, yes, but give the trade room to unfold. Many traders jump from one system to another, searching for certainty that doesn't exist. The truth is, there's no secret formula, only the consistent execution of principles aligned with probability. Have you mastered patience? Have you trained your mind to see opportunity without needing to control it? If not, the market will expose that. It rewards psychological stability and punishes emotional need. Money management is part of that psychological framework. You never risk so much that one trade can destroy your confidence. Even a high probability setup can fail. That's the essence of probabilities. Uncertainty is built in. The professional accepts this and adjusts size accordingly. When a trade works, they press the advantage systematically, not emotionally. That's structure, not gambling. A high probability trade isn't just about entry. It's about managing the mental environment around it. It's about adding when the market confirms your belief and protecting capital when it doesn't. Think of trading as a mental business. You wouldn't run a store without knowing your inventory, costs, and margins. Likewise, you shouldn't trade without knowing your emotional limits, risk parameters, and edge. Every dollar you risk represents belief, your psychological inventory. Would you waste it chasing randomness? Of course not. High probability setups are your prime opportunities. Save your focus, capital, and emotional energy for them. Here's another truth. The crowd is almost always wrong at emotional extremes. The majority buys when it feels safe and sells when it feels necessary. The high probability setup often appears right when emotions peak. Can you buy when fear dominates and sell when greed blinds others? Not by prediction, but by reading behavior, volume, and structure. That's the essence of trading in the zone: detached, objective, and aligned with probability. That's not contrarian for the sake of it. It's intelligent alignment with probability. What you must develop is a mind that perceives clearly and waits patiently. Don't clutter your charts with endless indicators or flood your mind with noise. Don't drown in analysis, news, or opinion. Focus on what truly matters: price behavior, volume, trend, support, and resistance. That's all you need to recognize high probability conditions. Everything else feeds confusion. Do you think the most consistent traders need 10 oscillators to confirm a decision? They don't. They observe the market's behavior and interpret its message. They understand the flow of energy between buying and selling pressure. They know when conviction is increasing and when it's fading. Keep it simple. Keep it sharp. Keep it focused. Above all, remember, trading isn't about being right on every trade. It's about operating from probabilities over a series of trades. You can be wrong half the time, and still achieve extraordinary results if your winners outweigh your losers. That's the essence of thinking in probabilities. That's why high probability setups matter. They tilt the balance of expectation. They ensure that when you win big. And when you lose, the damage is limited. That's the psychological framework of consistency. A breakout after a long consolidation is one of the most favorable probability conditions you can find in the market. Yet most traders misunderstand it, misuse it, or fail to wait for it. The market moves through alternating states of expansion and contraction, activity and rest, energy and release. It does not move in straight lines. It breathes, it builds tension, then expresses it. That pause, that period when nothing seems to happen, when emotions fade and boredom sets in, is not meaningless. It's psychological compression. It's the buildup of energy waiting for direction. The longer a market builds such tension, the more meaningful the release. Isn't that intuitive? Emotional energy builds, participants get fatigued, and when equilibrium finally breaks, price accelerates because collective conviction shifts. That's why a confirmed breakout after consolidation has a strong edge. It represents the release of stored energy, the market showing its hand. Now, why does consolidation occur? After a move, expectations diverge. Early buyers take profits. Late entrants hesitate. Shorts test conviction. Price settles into balance. Volume declines. Emotional energy resets. Most traders interpret this as stagnation. But under the surface, professionals are quietly building positions, absorbing supply while others lose patience. They use time to mask intent. Can you imagine what happens when they've completed accumulation? When the weak hands have sold? When resistance thins? When tension is maximum? A small influx of demand ignites a large move, because there's no one left willing to sell. That's the essence of the breakout. The market's psychological imbalance finally resolving. Yet most traders can't wait for proof. They anticipate, hoping to catch the move early. But hope is not probability. How often have you entered before confirmation, only to watch price reverse back into the range, draining your capital and confidence? That's the trap of anticipation, trading from fear of missing out instead of trust in your edge. High probability trading requires evidence, not prediction. Yes, confirmation costs you a little in price, but it buys psychological safety. Would you rather pay a small premium for evidence or take a discount on uncertainty? That's the difference between acting from confidence and acting from fear. A confirmed breakout isn't just price-piercing resistance momentarily. It's a decisive shift confirmed by participation, volume expanding with conviction. Volume reflects commitment. It measures collective emotion in motion. If price rises without volume, conviction is missing. But when both surge, the message is clear. Demand has overwhelmed supply. That's the market communicating in probabilities, not guesses. Think about the mindset of those trapped in the range. Buyers near the top want out at break-even. Shorts near the bottom expect a decline. When the breakout occurs, shorts are forced to cover, fueling the rally. Late sellers and hesitant buyers now rush in. This cascade of emotions, fear, regret, urgency, fuels the move. You're not just buying strength, you're participating in a collective shift in psychology. Duration matters. A longer base represents a deeper emotional reset. The longer the market sits still, the more participants abandon it. The more complete the accumulation, the more powerful the breakout. When you see a market resting for months, then suddenly breaking free with volume and intent, that's a clear shift in probabilities. How many traders ignored it during that quiet phase? How many lost patience? And how many will now chase it when it's obvious? That's your edge, your reward for emotional control. Still, not every breakout succeeds. Markets love to test conviction. False breakouts are the market's way of shaking out the undisciplined. How do you protect yourself? You wait for confirmation, monitor participation, and define your risk before entering. A true breakout shouldn't immediately collapse back into its range. If it does, you exit, without hesitation, without emotional attachment. That's professional behavior. The beauty of this setup is the asymmetry. The risk is small, the potential large. Your stop lies just below the breakout point. If it fails, you lose little. If it works, probabilities compound in your favor. That's the definition of an edge. Limited risk, unlimited potential, applied consistently. Context matters too. Breakouts aligned with the broader market's momentum tend to succeed more often than those that fight it. When the market's psychological energy supports your trade, probabilities rise. A breakout during a strong trend attracts capital and confidence. In contrast, fighting the dominant emotion, trying to buy strength in a weak market, stacks probabilities against you. Relative strength is another key component. A market or stock that holds near its highs while others weaken demonstrates underlying demand, quiet strength. When the broader environment shifts positive, those are the first to move, often leading the next cycle. Are you paying attention to which instruments resist decline? They reveal where conviction hides. A confirmed breakout is rarely the end. It's often the beginning of a campaign. That's where sustained profits emerge. Most traders take small gains after the first thrust, but the consistent trader understands that the first move validates a potential new phase of trend. Selling too early sabotages your edge. It's better to ride the wave with structure, adding gradually as the market confirms, not reacting emotionally to fluctuations. That's how you let probabilities compound. Discipline is the cornerstone here. Waiting through consolidation tests patience more than any other condition. The market moves elsewhere, and you feel left behind. But discipline is the art of waiting for your edge, not chasing stimulation. Consolidations can outlast expectations, but their resolution rewards focus. Can you sit in psychological neutrality while the market tests your patience? That's where your inner work pays off. Sometimes breakouts fail because they become too obvious. Everyone sees them, and emotion crowds the setup. When the crowd piles in, probability shifts. The best opportunities often lie in the less obvious, quiet setups that look dull to the untrained eye. By the time the public notices, professionals are already positioned. Are you seeking those subtle signals or chasing what feels safe? The former demands awareness. The latter guarantees mediocrity. Risk management anchors the process. Never assume any setup will work just because it looks good. Define risk. Place your stop. Accept failure. A high probability setup doesn't mean certainty. It means positive expectation over time. A few small losses offset by one or two major wins create steady growth. Don't fear being wrong. Fear holding onto wrong beliefs. Look back through market history. The rhythm is timeless. Balance, breakout, expansion. The heartbeat of human behavior. Whether railroads a century ago or tech stocks today, the patterns persist because human emotions don't evolve. Consolidation is indecision. Breakout is conviction. Trend is follow-through. The actors change, psychology doesn't. The lesson is simple, but simplicity demands mastery. You must train your perception to recognize these emotional structures, train your patience to wait through uncertainty, and train your mind to act without hesitation once probabilities align. This is not mechanical work, it's psychological discipline. If you call yourself a trader, mastering the breakout isn't optional. It's essential. The trend is your ally, not your adversary. Yet traders still fight it, trying to prove they're smarter than the collective. They short strength or buy weakness because their ego demands control. But the market isn't a debate. It's a mirror of collective belief. It doesn't care about your opinion or mine. It moves through probabilities expressed in mass psychology. The trader who fights the trend is like someone rowing against the current of their own belief system, exhausting themselves instead of flowing with probability. He exhausts himself. He makes little progress, and eventually the current pulls him under. Isn't it wiser to let the current carry you, to flow with it rather than resist it? Think of it this way. When a market is in an uptrend, forming higher highs and higher lows with volume expanding on the advances and contracting on the declines, it's revealing the underlying psychology of strength. It's showing you that the collective belief, the emotional balance of buyers and sellers, favors demand over supply. Isn't that the side you'd prefer to align with? So why stand against such evidence? Yet so many traders pride themselves on predicting turning points, on calling tops and bottoms. They want the recognition of being right, the emotional satisfaction of saying, I sold it at the high. But recognition doesn't pay bills. Profits do. And profits flow to those who align with probabilities, not those who challenge them for ego's sake. Human nature resists simplicity. We want complexity because it feels like control. We believe there must be a secret, a hidden pattern, something we can outthink. But the truth is simple. The greatest traders didn't invent trends. They observed and aligned with them. They didn't fight the market's energy. They flowed with it. That's not coincidence. It's cause and effect. The largest profits always emerge from harmony with the prevailing direction because the market rewards alignment with collective momentum, not defiance of it. Consider the psychological cost of fighting the trend. When you short strength, every uptick triggers stress. When you buy weakness, every downtick breeds doubt. You're fighting probability and emotion simultaneously. Each move against you amplifies discomfort until conviction crumbles. Compare that to trading with the trend, where pullbacks are expected, not feared, where temporary corrections are part of the process, not a threat. Which emotional environment would you rather live in? Constant stress or calm alignment? Trading is challenging enough without adding internal resistance. A trend doesn't move linearly. It ebbs and flows, expanding and contracting, testing your patience, not your intelligence. Many traders interpret a normal retracement as a reversal. They panic at the first sign of red, close their positions, and then watch in frustration as price resumes in the direction they abandoned. Others even short the pullback, mistaking it for the top, only to get crushed when momentum returns. Do you see how emotional misinterpretation of probabilities leads to repeated loss? The desire to call reversals comes from ego, the need to outsmart the collective. Traders see price rise and think it's gone too far. It must fall. But too far is not objective. It's emotional. A market can go further in either direction than reason allows because collective emotion drives it, not logic. The trend continues until the underlying belief structure shifts, and not before. Guessing the turn is gambling. Following the flow is trading. Which identity are you cultivating? Trends often persist far longer than anyone expects because collective beliefs are self-reinforcing. When a company keeps growing earnings, institutions keep buying. When an idea captures imagination, demand compounds. When fear dominates, selling pressure feeds on itself. These forces endure because beliefs evolve slowly. They create waves of energy that carry prices to extremes. Reason might tell you a stock is overvalued, but as long as participants keep believing, overvalued can become more overvalued. Likewise, cheap can always become cheaper. Isn't it more productive to observe and adapt than to argue with what is? Following the trend requires structure and discipline. You must define what a trend means in your system: higher highs and higher lows, a moving average slope, relative strength, or another objective measure. The method is secondary to the consistency of its application. The real danger is abandoning your definition when emotion intrudes, when fear or boredom convinces you to override your plan. A single pullback doesn't negate a trend. A sudden spike doesn't confirm a reversal. The professional distinguishes noise from signal, fluctuation from transition. Can you stay neutral long enough to tell the difference? Risk management is built on that same logic. When you trade with the trend, your risk is defined logically, below recent swing lows in an uptrend or above swing highs in a downtrend. The trend itself provides a map for managing probability. Trading against it, by contrast, leaves you without context. Where is your stop when you short a stock making new highs? Where do you exit when you buy a stock that keeps breaking down? Without structure, you're guessing. And guessing is emotional, not statistical. Also consider the mental comfort of alignment. When you trade with the prevailing direction, you can let probabilities play out without constant stress. You can allow positions to grow. You can scale in systematically as the market confirms your belief. That's how consistency builds, through calm repetition of edge. But when you fight the trend, you're forced into hyperactivity, jumping in and out, reacting to every fluctuation, living in tension. Do you want your trading life to feel like struggle or flow? The answer determines your growth. History validates this principle endlessly. Look at the great bull runs or devastating bear collapses. Those who accepted direction made fortunes. Those who resisted were destroyed. It wasn't about superior intellect. It was about psychological alignment with fact. The market speaks through price. Trend is its language. But most traders are too proud, too impatient, or too fearful to listen. They interpret instead of observing, predict instead of responding, and the market humbles them accordingly. There's another dimension here, compounding. Following the trend allows you to pyramid effectively, to add to a winning position as probabilities increase. Each addition is financed by unrealized profit, creating a feedback loop of growth without disproportionate risk. That's how small accounts evolve into large ones. But you can't pyramid against the flow. You can't keep adding to a losing position without self-destruction. The only sustainable compounding is built on alignment with strength. A trader must learn to love the trend, to see its persistence not as limitation, but as opportunity. The market doesn't owe you reversals. It doesn't exist to validate your opinions. It only reflects collective belief and rewards those who harmonize with it. Have you trained your perception to recognize structure? Have you conditioned your emotions to stay patient within it? Have you accepted that the simplest truth, following what already is, might be the hardest discipline to master? These questions define your psychological maturity as a trader. Risk to reward remains the cornerstone of every high probability decision. Yet this is the principle most traders ignore in their rush to participate. They see movement, feel the pull of excitement, and act without context. But the consistent trader begins with one question. What's my expected gain versus potential loss? That ratio, that balance between risk and reward, is the mathematical and emotional foundation of every edge. Without it, even the best pattern becomes a random outcome. Have you noticed how two traders can see the same setup, and one profits while the other loses? The difference isn't in the chart, it's in perception and execution. One defines risk objectively and acts accordingly. The other reacts emotionally, adjusting stops out of fear or greed. Think of trading as a business. Every dollar you commit is working capital. Every position is an allocation of belief and probability. No rational business risks $1 to make 50 cents. A professional weighs potential reward against cost before acting. Why should trading be any different? Yet most traders throw money into the market driven by impulse, without asking if the expected value is positive. They chase, they hope, they pray, but they don't calculate. Consistency isn't about hope. It's about understanding probability, defining risk, and executing without emotional interference.